This is not investment advice. Trading is risky. Trading has risks. You should consult your licensed investment advisors, financial advisors regarding your trading decisions or investment decisions.
Monday, we got one of the Fed chairs talking. Once again, anytime one of these Fed chairs says something crazy, like the market, it can move the market up or down. So if you're trading at this time, it could be an issue. Here comes Isaac. Tuesday, we got PPI. This is extremely important. So like whether we come in hot or we come in cold, if we come in hot on inflation, this is an inflation number. On the core PPI number, it's forecasted at 0.2. Like if we come in at 0.3, 0.4, stocks are going to drop. If we come in light or like right at the number, stocks can potentially keep going up. This is pretty much going to, and then we got Jerome Powell. We got the actual Fed chair speaking on Tuesday. So like, how I would play this if I were actually trading on this day and that morning, I would specifically be trying to get out of my trade before this man speaks. So like if this is 10 a.m., so it's 7 o'clock PST, the market opens at 6:30 PST. If I'm in a trade at 6:30 and this guy is speaking, I'm going to get out of that trade before he even gets on the mic, because he's going to push the market up or down depending on what he says. So I might, like, let's say if I were day trading on Tuesday, I wouldn't even trade anything until after 7 a.m. until this man pushes the market one way or another, but he's going to push the market, especially if PPI data is coming in at 5:30, an hour before the market opens. So the main thing he's been saying lately is that we want to keep battling inflation. We have to keep battling inflation. And we're essentially going to be data dependent on whether or not we're raising interest rates or lowering interest rates. And the numbers that they're primarily looking at is PCE, but PPI is another inflation metric. So if this goes up, that means inflation is going up. So it's forecasted at 0.2%. If it comes in at 0.4%, the market's going to tank, because everyone's going to think, oh crap, they're not going to lower rates anytime soon. And that's what everyone is waiting on to determine if they want to buy equities or not, is, our rates going to go down? So this number coming in that morning is going to push the market up or down. And so like imagine, and this is what we've been seeing lately, imagine this comes in light, right? It comes in right at 0.2%. And the market pops up right in the pre-market at 5:30, and then 6:30 the market pops up, and then Powell comes in and says something crazy and says we're still not going to lower interest rates. Then the market could tank down like 30 minutes later. So I would be very wary trading Tuesday morning in general before Jerome Powell speaks. Like, just from like a trading standpoint, if you were day trading, Isaac, this for you.
Yes, sir.
Tuesday, like this class that I'm taking, she calls them hot zones, right? So there's going to be a hot zone at 5:30. There's going to be a hot zone at 7 p.m. PST, right? When these two people speak, specifically Fed chair. Fed chair is Powell. Fed governor is one thing, but this is the king. So like when the king speaks, everyone listens. What he's also been saying lately is that they're afraid of employment data. The Fed essentially has two mandates. To manage inflation is one of the mandates, and the second mandate is to try and keep full employment. So the one thing that could also cause them to cut rates is if unemployment is rising, or, so the two metrics that everyone is pretty much looking at right now is inflation data and unemployment data, or employment data, same thing, right? So if less people are being employed, it could cause the Fed to cut rates faster. And if inflation is cooling, it could cause the Fed to cut rates faster. So these are like the two primary metrics that people are looking at to determine whether or not Fed Chair Jerome Powell is actually going to cut interest rates, which is going to increase the liquidity in the markets, make money cheaper and easier for companies to borrow so that they can grow faster, right? So that's Tuesday. Wednesday, you got CPI, which is another inflation metric. So really, we got inflation data on Tuesday and Wednesday. But the PPI number is going to kind of be like, if this comes in hot, people are going to expect CPI to come in a little bit hot. There have been times where one has come in hot, one's come like in line. But generally, like if PPI measures are up, CPI measures are going to be up too. So Wednesday morning, same thing, get some more inflation data, some more Fed speakers coming in towards the end of the day. And then Thursday, you got jobs. So here's the expected number of jobless claims, which is 219,000. That's the forecasted, right? That's the forecasted amount of jobless claims. So if this comes in high, which is bad news, the market is going to like that. So this, once again, we're in like this bizarre world where bad news is good news. So if there is more unemployment, that is good for stocks because the Fed is going to potentially have to cut interest rates to spur economic growth. So if this comes in at like 250K, then that's good for the market. But if this comes in at like 190,000, that's bad for the market. That means we're at full employment. The Fed doesn't have to worry about jobs, and inflation. Let's say the worst thing that can happen for the market is that on Tuesday and Wednesday, these numbers come in hot. Core CPI comes in hot. Year over year comes in hot too. That would be the worst thing for the market. And in addition, this number coming in light. So if inflation comes in hot and jobless claims comes in light, that's the worst thing that could potentially happen for the market next week. Because then the Fed is going to be nowhere near cutting interest rates. And if the Fed is nowhere near cutting interest rates, then there are going to be a lot of stocks that are dependent on low interest rates that are going to fall. And really, the stock market is more like a forecast of what's going to happen in 90 days and 6 months in the next year, right? And so really what people want to see is that within the next 3 months, within the next 6 months, that we're going to get an interest rate cut or two. So if jobless claims come in light and inflation data comes in hot, that's the worst thing that can happen. And then we're probably going to see stocks tank, especially like your low caps, your Russell stocks, your IWM stocks, things that aren't the mega caps. Even the mega caps aren't going to do well or great. I just think the whole market's kind of going to fall. People will probably start going into safety items. Like we're already kind of seeing that with consumer discretionary stuff, utilities, the safe plays rather than the newer tech things that really require a lot of cash and capital to push their business. So that's kind of what we're looking out for next week. We got inflation data. We got Jerome Powell speaking on Tuesday, and we got jobless claims on Thursday. Right. And you got a whole bunch of other Fed speakers on Thursday too. But Powell is going to move the market the most on Tuesday. All right, now we got earnings calendar for next week. Monday, nothing huge. Tuesday, you got Home Depot. That's kind of a stock like to determine like how the economy is doing. Are people buying more construction products? How well are they doing? Are people buying more homes, fixing up their homes? Wednesday, nothing huge. Cisco, but nothing huge. Thursday, you got Walmart. That's another huge Walmart and Deere and Applied Materials, kind of a chip company as well. So specifically Walmart and Deere, these are going to be two like determining kind of how the general economy is. If Walmart is producing great profits right now, then the general consumer is probably still looking good because everybody shops at Walmart. I don't particularly, but everybody else does. Deere, same thing, construction equipment, or not construction, but like farming equipment and things like that nature, tractors. How well is that industry doing? But this is kind of like an economic bellwether as well, because it kind of pairs with Caterpillar. They're pretty much doing the same thing. Caterpillar's like number one in the space, Deere's too. So you got, on Tuesday and Thursday, you got a couple of big companies, and Friday, not so much, right? So, and then if you think about it too, like Home Depot coming in with earnings with the inflation data, as well as Thursday, you got Walmart coming in with the jobs data. So those are going to probably be two big days that like push the market up, right? Depending on how Walmart does, depending on how Home Depot does. Those are kind of like consumer staple type of companies. Retail as well. Once again, let's go to Coifis. So now we kind of touched on macro. We're towards the end of earnings period. You still got a couple of big companies that have yet to report earnings. Like I believe Nvidia hasn't reported yet. Let's go look at when the Nvidia's earnings date is. Nvidia's reporting May 22nd. That's probably the last of the big companies. I would say that after this date, then we're kind of out of earnings. You're still going to have a few people like reporting, a few companies reporting, but like this is the last like big one I think coming up is like May 22nd. That could push the market. Like if Nvidia does really well, it's going to push chips back up. If it tanks, it's going to push chips and a lot of tech down. But this is probably the last one that we're waiting on to kind of end this quarter's earnings period, right, for quarter two. Or actually quarter one earnings, I should say. This is, once I said Coifin, this is the free version of Coifin. I go to the market dashboards and go to the US sectors to kind of see like, from a day trading standpoint, what I'm going to be trading next week is probably going to be dependent upon like what's been hot over the last like month or so. And if you look at like sectors, what sectors have been hot over the last month? It's been utilities. I don't really trade utilities because it's not really liquid, but XLP has been booming. This has been the consumer staple stuff. Gold, KRE, which has been the regional banks, and the financials, the standard banks and insurance companies, XLI, which is industrials, and then healthcare. And then you'll see kind of everything else. Tech has been either even or down the last month. You got chips. It's been close to even. Tech has been a little down. XLC, which is communications, which is comprised of mostly like Google, Meta, Netflix, Disney stocks has been down. XLY, big components of XLY, Tesla, Amazon are the two major components of XLY. That's been down, even though Amazon's been doing pretty well. XME, metals, things of that nature, real estate has been down. Energy has actually been down the last month. XOP, which is also like oil as well. OIH, oil too, oil services. What's XOP? XOP is oil and gas, and XLE is energy, right? So why is this important? I'm just looking at like what's trending right now, most recently, what's the strongest, right? So if we're going to go look at what's the strongest, you got utilities. This is like kind of fear stuff. If people are fearful, utilities kind of do really well. But I don't really trade anything inside of this ETF. So the next thing that I would probably look at for being strong is going to be XLP. So if we're going inside XLP, I would just type in XLP holdings. XLP holdings. I go inside holdings. And then you want to see like what are the weights of the things inside of XLP. So just looking at what has been the strongest over the last month, it has been XLP. So what's inside XLP? You got Procter and Gamble, you got Costco, you got Walmart that's reporting on Thursday, you got Coca-Cola, and you got Pepsi, right? But if you look at what's the highest weighted, Procter and Gamble is weighted the highest. Costco second, Walmart third, Coke is fourth. So chances are if XLP is going up, all four of these stocks, or probably 3 out of the 4, are strong as well. You guys feel where I'm going with this?
Yeah.
Right. So let's go look at the charts. Can you see my chart or no?
No.
All right. Can you see my chart?
No, there.
All right. So let's go to Procter and Gamble. Look at Procter and Gamble. Does it look strong?
Yeah.
Right.
Going up.
Look at Costco. Does that look strong over the last month or so?
Yeah. Maybe.
Right. And then Coke. How does that look?
Yep.
Right. So that's where the strength is right now. Let's see. What else was there at Walmart? Walmart looks the weakest. It's going sideways. So from a trading,
And you're basing that on the consumer. Yeah.
on the ETF.
What products that they buy.
So I'm just showing you like where to look for strength, right? So using this Koifin tool, it's essentially aggregating the data over the last month, what's been strong. You can do the last quarter, but like how I've been trading recently is like, I want to go with the things that are trending upward. I want to find the things that are trending upwards and try to buy them on a pullback, right? So right now, the things that are trending upward are XLU over the last month, XLP, pretty much everything over this middle line right here, right? These are the things that are trending upward. So I want to go try and find strength inside of these ETFs that are trending upwards. Because let's say as a retail trader, if I buy or there's a lot of volume coming in to the upside on XLP, when you're buying XLP, what are you buying? You're buying Procter & Gamble, Costco, Walmart, and Coke. So if people are buying this ETF, then what has to happen is that the stock has to go up in those top names, right? You see it? Does that make sense?
Yes.
And conversely, the same thing. If people are buying more Costco, the ETF that heavily weights Costco is also going to go up. So if you see Procter & Gamble going up, Costco going up, and what was the other one? Coke going up, and Walmart is pretty much even, then I can almost tell you without even looking at XLP that XLP is going to look like those other stocks. That looks just like Procter & Gamble stock, right? This is XLP, this is the ETF. But if you look at Procter & Gamble, the chart looks similar. If you look at Coke, the chart looks similar. And it's because they're all linked. And so this is one of the main things that I wanted to touch upon today is like understanding how sectors and ETFs are linked. So if XLP is mostly comprised of Procter & Gamble and Costco and Walmart and Coke, then this is where, like, if I'm going to be trading, I want to be looking for some sort of pullback in the strength, because if the whole sector is doing well, this is where I'm going to be fishing for potential day trades, specifically like over or short swings, like anywhere from a day to a week or a week and a half, right? It's going to be in these names. From like a trading standpoint, not long-term investing, but from a trading standpoint, I'm going to look at what was strong, what is still strong, but I'm not going to buy this here. I'm going to wait until this maybe comes down, like it has a bad day, and then I'm going to buy it into strength, right? Because over the last month, this has been the strongest sector, consumer staples. You feel me? So like this would have been a really good day to buy on XLP on this particular day. In fact, my trading class got in on this day and I missed it because I wanted it to come a little further and it didn't go. But this would have been a really good day to get in on XLP because it's strong. It's been trending higher, but you don't want to buy it on a high. But if you see a day like this where it comes back and you want to get it on a pullback, that would have been a better day to grab it. Right, from like a trading, for even a swing perspective, like swinging this thing, you know. But this has been the sector that has been strong. Let's go to the next strong. So after XLP, you got gold. Gold has been doing really well lately too. We're gonna share GDX. Thing about GDX as an ETF, it's not extremely I don't believe it's heavily weighted, and it's kind of weird. Trading a commodity is a little bit different, but like this is a gold miners ETF. This is also something like to potentially look at. So if gold right now it's pulling back, if it pulled back a little bit more, this has been a place of strength. And if you look at zoom out a bit. That looks pretty good over the last since April, over the last month, gold has been killing. Right? It slowed down, but then it's coming back up, but this is kind of a source of strength. So I'm just looking at the chart right here. This green line that I always have drawn is the 21-day moving average. Gold seems to do really well if it pops off the 21. You might want to give it some wiggle, but every time it's reached the 21, it's popped up. You guys see that?
Yep.
So this is another trade. Like if gold were to pull back a little bit more, especially if it got to the 21, and the 21 is going to be dynamic. So if it got down to like $34, gold has been relatively strong. And especially like if this inflation data comes in high again, gold would potentially be a good place to kind of hide out, because if inflation data comes in really high and let's say jobless claims come in really low, which is the worst scenario situation, people are going to try and figure out where they're going to put their money in like safety plays, which is why you see utilities up, you see like gold up. These are like more safety plays. So if you see a pullback on gold here and people are still scared that they're not going to lower interest rates, I think gold is kind of going to be in play, especially if it gets down to that 21-day moving average, just looking at the chart. And once again, the reason why I would trade this is because the sector has been trending upward. So I'm trying to find the strength, like what is the strongest? And then that's the stuff like, Isaac, if you're buying calls or if you're selling put spreads, like if you're doing any type of bullish trade, you want to be in the place where there's actually strength. And right now the strength is in consumer staples, XLP. The strength is in gold, GDX, XLU, except it's hard to trade XLU, but that's been going up too, you know, but it's not really liquid. But if you were to try to get this on a pullback, this has been really strong lately. And really, I'm trying to just show you guys how to find like the Nvidias when Nvidia isn't doing what it's supposed to be doing, right? Because like Nvidia pop, but look at what Nvidia's been doing since March. It's gone sideways. Yeah. So if you've only been trading Nvidia since March, you haven't gotten any money, right? It's been staying within this range. It hasn't gone anywhere. It's the hottest stock this year and of the end of last year. But right now, if you would have been in XLU, you would have made way more money. If you would have been in XLP, you would have made way more money. If you would have been in gold, you would have made way more money over that same time that Nvidia has been doing nothing. Right?
Yes, sir. You are.
So it's like, try not to get married to a particular sector. Nvidia and chips were hot when they were hot, but now they're not hot anymore. So you need to go find the better looking stocks, the better looking sector to trade in that particular time. And then conversely, let me go to the sectors. If I'm going to be shorting things, right? If I'm buying puts or if I'm selling call spreads, then what's been the worst looking stocks over the last month? Please. That's a question. Y'all there?
Probably Tesla.
No, I'm
Probably,
looking at look at these sectors. So what's been the worst performing over the last month?
Oh, I don't know what it is.
Energy, oil. So if I'm shorting, this is what I want to short. Oil services, oil and gas, and energy, which has a lot of oil in it. That's been the weakest over the last month. So let me go back here. So it really just depends on and ideally you want to go where the market is going. So if the whole market is up, I'd rather be going long instead of shorting. But look over the last month, what has oil been doing? It's been going down. So if you would have been shorting here, you would have been shorting here, you would have done really well shorting oil. XOP, same thing. So if you're going to, I still don't like shorting these because they're above their 200-day moving average. I would rather short things that are below a 200-day moving average. But these are pretty weak, and they mirror each other. So same thing.
What are your other?
Go ahead.
Well, what are your other lines? So there's 200-day average, and what are the other three?
So my green is the 21. My orange is the 34. My blue is the 50, and my yellow is the 200.
Gotcha.
And this is my big sentiment line, in terms of strength. Well, actually, if the entire market, the S&P 500, the Dow, the NASDAQ, the three main levers, and maybe the Russell, if they're below this 200, I'm bearish. Then we're probably likely heading into a bear market, or things don't look that great. If they're all above the 200, I'm more likely to be taking things long than shorting them, right? So we go look at the general market. I've been looking at the futures more just because they're open 24 hours, but this is the S&P 500 futures. Look at the 200. It's well above the 200, which means we're still in the bull market, right? The NASDAQ, which is the tech sector, well above the 200, which means we're still in the bull market. The Dow, the industrials, financials, well above the 200, which means we're still in the bull market. Russell, which is the small caps. The only one that's kind of close that hit it, but still right now we're well above the 200. So if all of the major indexes are above the 200-day, I want to be more buying calls versus buying puts, right? That makes sense? From a sentiment standpoint, people are still more bullish than they are bearish. If they were bearish, where they think the market's going down, all of those sectors that I just pulled up would be below this 200. So if I wake up and everything's below this yellow line on the major sectors on the S&P 500, then I'm scared. Then I got tight stops on everything if I'm going long, but I'm looking for puts. I'm buying more puts. I'm selling more call spreads, which is a bearish trade. Then I'm going, then I'm buying calls or buying shares of things, right? I'd be more likely to short things if they're all below here. But right now, we're well above the 200. Look at the S&P 500. We're well above the 200. We're above the 50, which is really good. What people call the death cross is when the 50 crosses below the 200. Look how high on top of the 200 the 50 is. So we're still bullish. We're still in a market that looks like it still wants to keep going up, at least in the near term. Here's the tech, NASDAQ, which is mostly tech, well above the 200, above the 52. Like we're bullish still. So while there are some sectors that haven't been performing so well, like energy over the last month, it is still relatively bullish because look how high it is above its 200-day moving average. But this is where the weakness has been over the last month, has been in energy. And then just to kind of go back and do the same thing in terms of like, if we were thinking about doing a short-term short on energy because it's been the worst performing, where I would go look at XLE and go look at XLE's holdings. Right. And what are the major weighted stocks in XLE? Exxon, Chevron, ConocoPhillips, EOG, Schlumberger, Marathon. But the two main weighted are Exxon and Chevron. So since XLE has been down, I would expect that Exxon and Chevron have been down as well. Right? Does that make sense? Yeah. So let's go look at Exxon. It has been. Looks just like XLE. Let's go look at Chevron. Actually, Chevron has been holding up pretty well. But it is a little bit lower weighted, not by a ton, but Exxon is the main thing that is propping up XLE. So you're seeing Exxon look exactly like XLE, right? The chart looks almost identical. Right? Did you guys see that?
Yeah.
The chart looks identical. And this is kind of too where you could have like an arbitrage opportunity. Like if you know that Exxon moves with XLE and Exxon is up and XLE is down, then you could short Exxon and then go long on XLE until they come together because you know they move together, right? And then just from a sentiment standpoint, if you see XLE that has all of the names, if this starts tanking on Monday, then I'd be more likely that day to buy puts on Exxon because the whole sector is tanking. And so you kind of want to follow the sector. So let's say, like, I really don't want to short this for a long period of time because it is above the 200-day moving average. But like right here, if you would have shorted it for a day or two, you would have did really well. Here, if you would have shorted it for a day or two, you would have did really well too, right? So same thing. If this thing right here, if I see on Monday that XLE is having a bad day, and let's say it pops back up to like this level or towards 95 and then starts tanking, then I could look at a trade on Exxon, especially if it hasn't tanked yet, and it's likely going to follow the sector. But if I wanted to trade Exxon and buy puts and take this down, what I don't want to see is XLE being up. If XLE is up, I'm not going to short Exxon. Does that make sense?
Yeah.
Because it's the fact XLE is the entire sector. So if the whole sector is up, then why would I take this short? Because then it has to fight the entire sector in order to go down. So I would rather take like something in XLP if the whole market is up. But like if we wake up on Monday and it's because right now Schwab is all of my stuff is changing this week. Because the TD Ameritrade switch to Schwab, at least for my account, is happening this week. So everything's changing to Schwab on Monday. But I already have a Schwab account. So I'm using my daughter's Schwab account.
Good.
But here we go. So here are all the major sectors: S&P 500, NASDAQ, Dow, Russell. This is crude oil. This is gold. These are bonds, right? So let's say I wake up on Monday and all of these sectors are down and they're down heavy. So I'm not going to be trading anything long that day unless we see a reversal within within the first 15 to 30 minutes of the stock market opening. But if everything is still down, then I'm going to be more confident, like shorting an Exxon or shorting an XLE, because if everything is down, that's the ocean, right? So this is why I always have these up. This is the ocean, right? And then let's think of ETFs. XLE is like a current within the ocean. And then this is XOM, a stock is like a boat in the ocean. So I would rather that if the ocean is down and the sector is down, I want to be shorting the weakest stock in the weakest sector to have a more probability of a follow through of this to the downside. Does that make sense? I don't
Yes, sir.
I don't want to fight the time.
Yeah.
I don't want to fight the time.
Now, I know before we discussed, there were three different ways to short the stock. Which way are you talking about right now?
So it depends for me. I'm in a position right now where I tend to either buy puts or sell call credit spreads, depending on the liquidity of a particular ETF or a stock. I don't generally short the standard way, which would be going into active trader and selling, let's say, 100 shares of Exxon at a particular price. So if you wanted to short Exxon, if it got to 119, right, you could go into active trader right here, which is over here, and then put a sell order right here for 100 shares of Exxon. That would be shorting it, right? Shorting the shares. This is the standard OG way to short or take advantage of a stock dropping, would be to short the shares. It would be to borrow 100 shares from your platform and then sell them for 119. Hope that the stock drops to 118 or whatever your target is. Buy them back for that amount, and then you make that dollar in the spread, right? That's shorting in the traditional way. I don't like doing that because you got to put up a whole lot of capital and have to have a margin account in order to do that. You don't need a margin account to buy puts. You do need a margin account to sell spreads, right? But I can leverage my capital a lot better by buying puts or selling spreads. So let's say Exxon, I wanted to short it if it got up to 119. Not saying that I want to do that, but let's just say if it got up to 119, I think it's going to be overextended and I want to short it right there, right? If I wanted to short it at 119, I could buy a put. Where's X? X? Wait, where does this option chain look weird? Hold on. At 119, it's traded. And we're going to... Oh, Exxon has this weird option chain for some reason. Yeah, look out for that too. Because this option chain right here, I don't know what this is. This is where all the normal strikes are, but I don't know what that was, right? So here's the standard option chain, right? So this is the put side. So if I wanted to short Exxon when it got to 119, I would probably be looking for something that's going to be in the money. So I would look at the 119s, right? But then when I look at the 119s, oh, actually it has really good open interest. So I like this to be over 1,000, definitely no smaller than 500 or 750. But if the open interest is over 1,000, that means there's really good liquidity. There's a lot of people, at least 1,200 people that are willing to buy and sell this particular option at this strike price. So it's going to be easy for you to get in and out of this trade, most likely. Now, the spread between the bid and the ask is 26 cents, which is a little bit higher, but that could be because we're in the aftermarket right now. We're not like, this might be closer if the market was actually open. So it's kind of hard to look at an options ladder when the market is closed, because these numbers are going to be kind of dynamic. So I don't know what this spread is going to be when the market's actually open. But this looks like it has a decent liquidity. So if I wanted to short it when it got to 119, I'm going to click on the ask button. That's how you buy an option. Click on that. Get more block. And let's say I wanted to buy $800 worth of this. Like, let's say that was my max spend was $800. Then I buy approximately 4, give or take, right? Because once this moves closer, once this stock price moves closer to 119, then this one is going to move where 118 is, and it's probably going to be closer to $1.78 versus 246. And I can tell just based upon, like, this is going to be closer to the money when this stock price actually gets to where we want to short it. Does that make sense?
Yeah. Yes, sir.
Right? You see where this is right now. Like 119 is like 2 strikes out of the money, and 118 is right at the money because the stock price right now is close to 118. So if the stock price is close to 118 right now, then when 119 replaces this, it's probably going to be closer to $1.78 or $2. So if you were trying to risk $800, you could buy 4 to 6 of these and it'd probably get you close to your $800. If you were trying to risk $1,000 and the current price is 178, then like maybe 8 of these, buying 6 to 8 of these, right? So if I wanted to short Exxon, I would buy puts. And I know by the time this gets to 119, this is going to be closer to $2. So I'm going to buy 4 of these because my max risk is going to be $800, right? So I'm just saying how I would set it up. And then I wouldn't enter this trade until this stock gets close to my price. Right? So if I see it climbing and getting to 119, I'm going to see the price of this option fall, right? It's 246 now, but I know as the price goes up, the price of this option is going to fall. And my goal for buying a put or buying a call is to get it for the cheapest price that I can and hope the price goes up. Because if it falls at 119, then the price of this is going to go up to $2.40 to $3 to $4 if it falls all the way down here, right? Maybe even more than that. So as a put, as the price of a stock goes down, the put gets more expensive. So we want to buy low and sell high for puts, right? So that's the second way that I would short this if this got to, let's say, 119. The third way that I would short this would be selling a credit call spread. So I'm looking for the same thing when I'm selling a credit call spread. So I would actually take this trade with a call spread instead of a put for one reason, because there's liquidity here on this strike. Well, actually, no. If I'm selling a call spread, I would be selling the 119, which would be at the money. So, yep, this has 3,000 open interest. I don't like the price of it though. This might just because we're in aftermarket. I don't like how it's priced. Let's just take these. So if we're close to 119, you're going to see this strike move to be in the money where this 117 is right here. Right? And so the 117s right now are currently priced at 113. And I would probably even go a little further in the money here too. But this is going to be my trade. How I would set it up ahead of time is I would buy this one, or I would sell this one, that has open interest of 3,000. And then I would buy the one below it. Right now, this is only $28 or 28 cents because it's for 100. So I would have to sell like 50 of these for this to even be worth my while. And this is why I'm saying, like, I'm not worried at what the current price is, because I know that if this gets to 119, the price of this spread is probably going to be closer to what these numbers are right here. So it's going to be close to like $1.94, because the ones that are at the money and then 2 out, that's how much the spread costs. But that's not the one that I would buy or sell. I'm sorry. This is another way to short the market, would be selling a call and then buying a call 2 strikes below. The reason why I would prefer a spread is because if time is against me, I'm going to make money. Here, if I just buy a put, time is not on my side. I need the move to happen quickly because theta is going to be eating at the value of this option. So if this takes all week or all day to move, I'm going to lose money. In this case, if I sell a spread, if Exxon goes sideways and just stays sideways, I will make money because I'm selling premium in this instance. So if Exxon goes down or stays sideways, I make money by selling a spread. So that's why I like selling spreads. It's because I do have a defined amount of how much that I can make, but I'm selling a spread because I can benefit off this thing going down or going sideways. If I buy a put, I only benefit if this thing goes down, and I need it to go down quickly, or time is going to eat away at the value of my option. And neither is wrong, especially if, like, let's say you were trading something like SPY and you were expecting that move to happen that day anyway, because you're trading a 0 DTE, a 0 days to expiration type of option, then like time decay matters less because you're trading for this thing to expire at the end of the day anyway. So you're probably going to try and get more alpha by buying a put rather than necessarily trading a spread. But for me, it's more depending on like what's the open interest like at the strike that I want. So like if the open interest on this put is only 358, but this is where I want to be, I wouldn't trade this. I would go try to find a spread that does the same thing. So like looking over here on the call side, it looks like there's more liquidity over here, right? You see that? Let's say we wanted to short SPY if it got up to $521 and I wanted to buy a put. If I tried to buy this put, there's only 358 people willing to buy and sell this put. So I wouldn't make that trade for that reason. So I'm like, I really like this trade, but I don't like the liquidity. So I'm not going to use that instrument. Instead, I would rather sell a spread because looking at this option at 521, if I sold this one, there's 4,000 people here. And if I buy this one, to hedge this one, there's 4,000 people here. So this spread that I took is going to be a lot easier to get out of than this put. Am I losing you?
I think I mainly got it, but I'm hoping your stream, your recording works.
Is it lagging?
No, I'm saying everything's fine now. I'm saying I'm gonna need to go over it again, so I'm hoping the recording works.
So there's 2 ways to take, or 3 ways to take advantage of a stock price going down. You can short the shares, which is what I showed you on the chart, an active trader. This is the fastest way to do it. So if I wanted to short SPY at 521, I could go find out where that price is on the ladder and then click that and sell 100 shares and short SPY. If it got up to 521, then I'm going to short it, right? So that's way number 1. You would short the shares, except if you wanted to short 100 shares of SPY, that would cost you $50,000, $52,000 to be exact, $52,100. You see where I'm getting that from?
Mhm.
Right? That's expensive. If you got $50,000 lying around, great. You know, you can short the shit. But the less expensive way to short to short SPY would be to buy puts. You could buy a put on SPY for $113. That's way less than $52,000, right? So
Yeah.
that's the main benefit of using options, is that they are way less expensive, so you can leverage your money more than just shorting the shares. So you can buy an option, you can buy a put to short it for $113. You could buy 10 of these for $1,000 rather than $50,000. Same thing. Same thing. And if the reason why I wouldn't buy this put is because it's not liquid. There are not enough people that actually want to buy and sell this. So it'll be easy for you to buy it. But if the stock price falls and you're up, it's going to be hard for you to get out of this trade because it's not liquid. So I wouldn't take that. I wouldn't take this one. I wouldn't take this one. And this one's going to be out of the money by the time this reaches the price that we want. So I wouldn't buy puts. So this is why I'm saying this is a situation where I wouldn't buy a put. I would rather buy a spread, because by the time this 521 strike over here on the call side reaches in the money, it's going to be about $2.18, right? So I would sell that one. And then by the time this one is 2 away, it's going to be 91 cents. So the difference is going to be about $1. So I would buy that one. So I clicked on the bid to sell that call, and then I held down control and clicked on the ask to buy this call, and then I'm going to get a premium of this. But by the time this hits 521, the price difference is going to be close to $1, because 218 minus 91 cents is close to like $1.27 or $1.17 or whatever that number is. So if I want to risk $1,000 and I know that this is going to be about $1.17 when this price reaches 521, then I would just sell 10 of these, because that's what I want my max risk to be when this trade triggers, is going to be about $1,000. So I would sell about 10 of these. And the reason why I want to do this trade specifically is because there's 4,200 people willing to buy and sell this option from me, and 4,300 people willing to buy and sell this option from me, which is my hedge. And this is also a bearish trade, but this trade is going to be a lot easier for me to get out of because there's more liquidity. There's 144,000 people currently in this trade, 85,000 people currently in this trade, and 4,200 willing to get in or out of this trade, and 4,300 people willing to get in and out of this trade. So I would rather sell a spread, because this is going to be more liquid than buying a put, even though we're doing the same exact thing. We're betting on a stock to go down. And I have two ways to win by selling this spread, because if the stock goes sideways, I win because of time decay. And if the stock goes down, I win. If I buy a put, I only win if the stock goes down. Right? Anybody?
That makes sense.
Right? Same thing if we're going the other direction. Let's say I wanted to bet on this going up. Let's say if it gets to 521, I want to buy a call. And if it gets, I either want to buy a call or sell a put spread. So if I'm betting on SPY to go upward, I could buy a call at 521. I could buy this right here for 91 cents. So by the time this gets to being at the money, it's going to be $2. So if I wanted to risk like $1,000, then I would buy 4 to 5 of these, right? So I could buy a call or buy 4 of them to risk about $1,000, $800 to $1,000, right? And this would be a good call to buy. Why? Because it's liquid. There's 4,200 people willing to buy and sell this option. Versus if I wanted to sell a put spread, I could sell this put and then click control and then buy the put here, right? The only reason I wouldn't do this is an instance where I would rather buy a call because this 521 is not liquid. So it's going to be harder for me to get out of this spread because I would have to, in order to get out of this trade, I would have to buy back this option and then sell this one. This one would be easier to sell, but this one is going to be hard to sell because there's only 358 people willing to buy and sell this option. You feel me?
Yeah.
So this is an instance where I would rather buy a call to bet on SPY to go up because it's more liquid than trying to sell a spread on it. So that's why I said it would depend. Why would I sell or why would I buy or buy a call or a put? It depends on the liquidity. Why will I sell a call credit spread or sell a put credit spread? It depends on the liquidity. If the liquidity is better on buying a call or buying a put, I'm going to buy a call or buy a put. If the liquidity is better on the spread, I'm going to sell a spread because I have more ways to win. But what I don't want to happen is to have any issues getting out of a trade because there are not enough people willing to trade with me on that particular instrument at that strike. So picking your strikes are really important.
Yes, sir.
All right, before we end, any last questions? Anything you want to look at?
I ain't really do it.
AMD again?
You did it. Can we say MD is going down or up? Yeah.
I still got my alert set for 146, bro. That's still my breath.
Okay.
It bounced up a little bit, but I'm still waiting for it right here at that 200. Remember I said that's really where I want to buy stuff. Look what it did here.
Okay.
If it gets right back down to 146, I'm probably going to buy a leap. I could buy shares because AMD isn't that expensive. It's only $150. Or buy a couple of leaps, kind of at where we said earlier. If I were to buy AMD leap, I think we were looking at that June 25 or June 20th, 2025. I think we were looking at that 100 strike price. Yep, that still has 900 open interest, or that 50 that has 800. But I'd probably lean on that 100 strike price right there and try to grip it for like $6,200 instead of 15,000. You bought 100 shares, $15,000. I'd probably buy 2 leaps and spend 12 grand instead of 15 grand buying 2 leaps. And if it got around 146, I would even wait. So if this triggered at 146, I wouldn't buy it right away. What I would do is go inside the 5-minute chart and see if it's going to get as close to, what's this low right here? 141. If I could get it at 141 or 142, I'd be gravy, right?
Yeah.
That's ideal, but that you're being greedy. If you're waiting for it to go down, it may not ever get there. So I would be looking for it around 146 and give it some wiggle to below 140. That would be my stop. So if I could get it between 142 and 146, that would be great. And then at max, I would have a $6 stop loss. If I got it at 146, I would be placing my stop right here. Even if this is in my long-term account, I'd be placing my stop at like 139.75 or something like that. 140 is a nice round number where I feel like it could pop off of too. So I'd be placing my stop right here. So max, I would have $6 worth of risk. And then my reward potentially is up to 227. So what's 227 227 minus
All right, fellas, I gotta go. All right.
227 minus 146 is 81. So 81 divided by 6, that's a 13-to-1 risk reward ratio. If AMD ever got back to its all-time high, right? Which is where I'd be trying to do a long-term swing on potentially like a leap, right? So once again, from a risk reward standpoint, that makes more sense to me. Risking $6 to make $81. And that's the type of trade that I want to be in, right? If you look at where this mark is to here, that's a small window. And to get from here all the way up to here, that's the type of risk reward ratios that you want to take. But I'll risk $6 to make $81 any day of the week.
Yeah.
And you still with us?
Brent. Yes, sir.
Yeah, I'm with you.
Right? You feel what
That makes sense as well.
right? And then, but what I'm using as my major support level is this 200-day moving average.
Here.
It might go a little bit below it, which is why you got to give it a little bit of wiggle room. But this 200 is major support for most stocks. And I'm bullish on chips long term. Maybe not this month, maybe not this quarter, but long term, I'm bullish on chips in general, specifically AMD. Looking at their earnings reports, they beat on their earnings. They didn't beat as well as everyone thought they were going to, but they beat. So it's a good company. It's a company that makes money, that has a really great CEO, that's in one of the most booming sectors over the last year. So I'm bullish on AMD long term. And look at this discount. So if you would have bought it here at an all-time high, you screwed up, right, at 227. But right now, it's 40% off, right? It's 40% off the all-time high. So if it's 40% off, like you're getting it at a discount in a sector. So I would buy it from here to here, and then this would be my stop. Give it a little bit of wiggle, but that's my stop. If it goes below 140, it's probably headed lower, and then I'd wait to buy in at a lower price. But I would be willing to risk a couple $100 to grab it right here at the 200, because look at long term. Let's look at a 5-year chart of AMD. That looks good from a 5-year chart. Like AMD tends to go up. It has its down periods, but it tends to go up. But this big fall is a really big fall already, right? So I think it's almost exhausted. And you can kind of look at, if you go look at studies, let's go look at the RSI, which is a tool to determine whether it's overbought or oversold. I extend mine to 80 and 20 to see. And so if you look, it's at 40, but it was when it got, let's look here. When it got down to this low right here, it got down to the 20s, which is really low. Anything under 30 is really low. When it got here again, it got down to 30, which is really undersold. Oversold, which means all the people that were shorting this thing or getting out of their stock, most of them are going to be out if it gets back down to this level, which is like 142. So that would be like my main target. I'm going to start watching it if it gets to 146, and potentially buy it, but I really want it between like 142 and 146. If it gets down to 142, history has shown me that it's oversold and it tends to bounce from there. So that's kind of where I'm looking, right? I think most of the people that have been selling AMD that got in at the wrong time, the people that got in at 227 that bought it at the wrong time, they're already out. They sold somewhere around here, They cut their losses. Like Isaac, when you got into Nvidia, did you cut that trade yet?
Yeah, I'm cutting that trade, yeah.
That's exactly what I'm saying. So the people that got in at the wrong prices, they've already sold. They're gone. So the only people that are left, I think, in AMD are long-term investors that got it way back here somewhere. So they didn't care that it went up and came down because they got it down here, Those are the only people that are left that are like 5-year, 10-year traders. And if this gets back down here, I think most of the selling is going to be done. And this would be a good place to pick it up, would be in between these ranges right here. So that's how I look.
Yeah, I'm in one of those trades right now, so that's why I was trying to see what it's looking like. But it's looking like it's gonna be good. Kind of like a 2-month call out.
But that's what I'm looking at long term for AMD. This is more of an investment, though. I like AMD from a long term, just to go look. This is the last thing we'll do, AMD earnings. It beat on its earnings, right? So for me, that looks good. It's a company in one of the hottest sectors over the last year that's down right now, but it's down already 40%. So how much further could it drop? It could drop further, but not for a company that's actually making money. You know, it's actually making money. It beat on its expectations, is actually making money. And I think it got hit too hard on its earnings, similar to our Google trade. I think this is another one. If I could pick it up at the right price, I think they hit it too hard. Like, same thing with Google. Google got hit like all the way down here, but I looked at its earnings and it beat. And I was like, wait, why are they tearing up this company that's doing so well? No, right? Like here on Google. And now it's at an all-time high. I still own my car on Google, but it got hit on earnings. And I was just like, why? Oh, here it was. Here was earnings. Then you had that gap down. And then they kept hitting it. But I was just looking at the earnings. I was like, its earnings aren't that bad. In fact, they're good. Like, Google has billions of dollars of cash on hand. If its earnings were growing, it just didn't do as well as people thought. So I was like, let me buy this while it's discounted. It wasn't even that discounted. It was only 20% off at the time. I bought it and it went up. But I think AMD is kind of in that same boat. It's a company that I expect to be bigger. It was all the way up here. It's fallen from grace, but I think it's fallen enough. And it's consolidating, which means that like all of the sellers are kind of gone. This is one that I'm looking at. But I'm really hoping it gets down to 146. Like if it can get there next week, I'm buying.
Nice.
Yeah. All right. That's it for today, gents. I will see you guys next weekend. Happy Mother's Day to your wives, mother your kids, all of that.
Appreciate you. You too. Very good.
Thank you. Well, thank you.
All right, Bruce. Peace.